Welcome to RiskWire, our podcast on the house. And today we'd like to talk with you about the 2026 spring housing market. And we're going to be breaking down the spring housing market from the perspective of what the different data are showing us with respect to mortgage rates, affordability, the labor market, migration trends, inflation, supply, and economic uncertainty. My name is Eric Fox. I'm Chief Economist here at Veros Real Estate Solutions.
And I'm Reena Agrawal, Senior Research Economist here at Veros.
And today I will be moderating our discussion. I told Reena last time after we did a podcast on baby boomers, which I was the baby boomer and Reena was the moderator, that I would get even in an upcoming future podcast. So today's the day I get even and I get to ask her all the questions. But we're in luck. Reena is a wealth of knowledge on this topic, so they will be quite easy for her to address. So Reena, let's start by talking a little bit about mortgage interest rates. And when we look at what's been going on with mortgage interest rates here recently, it seems like they fluctuated in a fairly narrow band between about 6% and 6.5%. So why does such a move in such of a narrow band make such a big difference in the housing market?
Yeah, that's a great question. And I think right now, mortgage rates, they are at the top of any discussion when we're talking about the housing market. And before I answer your question, how mortgage rates have dipped just below 6% at the end of February. And that happened because inflation seemed to be under control. The labor market was resilient. The Fed had cut interest rates 3 times last year. And mortgage rates were slowly trending lower. And we saw them hit 5.98% at the end of February. But then the war in Iran happened, oil prices went up, and we saw mortgage rates go up to 6.5%. Why did mortgage rates go up because of the war? Because oil prices went up. And when oil prices went up, the risk of higher inflation went up. And when that happened, Treasury yields went up. This is because now investors were demanding a higher interest rate because of the erosion of purchasing power for the dollars they were getting back. So once Treasury yields went up, mortgage rates followed suit. So now we have mortgage rates at around 6.5%. And just talking about the Fed cut rates 3 times last year. But at the current moment, Wall Street investors don't think that the Fed will be cutting rates anymore, at least in 2026. So coming back to your question about why these small movements in rates matter, the median house price right now in the US is around $400,000. Now, when a prospective home buyer is looking to purchase a home, they are looking at the total monthly mortgage payments that they make when they take a loan to buy a house. Now, with a $400,000 home and with a 20% down payment, if they go from a 6% mortgage rate to a 6.5% mortgage rate, their mortgage payments over the course of 1 year would increase by roughly around $1,300. And that adds up to more than $35,000 extra in interest payments over the course of the loan. So for some folks, it's just that point between affordability and non-affordability. $1,300 may be too much for some people, so then they will withdraw from the housing market. Whereas for some folks, it is okay, because we have to remember that even though it is 6.5% right now, it's still around 20 basis points lower than what it was at the same time last year. So when you're comparing it to last year, mortgage rates are still lower. But if you're comparing it with the end of February, mortgage rates are suddenly 0.5% point higher. So it depends where people fall in terms of the monthly mortgage payment that they have to make. And that is why it matters a lot, even though it's moving a little bit, because ultimately the price of homes is at such a high level that it matters a lot.
Mm-hmm. So that's a very interesting discussion you had there, Rena, on the mortgage interest rates and the very rapid increase in the 10-year Treasury yield due to the oil shock. So let's play that in reverse. Let's suppose that there is a sudden and quick resolution of this oil shock. Would we see the same reversal occur with interest rates if such a situation were to occur?
Well, technically anything is possible, but in my opinion, I do not think it will happen so fast. I think we may start seeing positive movements in that direction, but it would take weeks, if not months, for rates to come back down to that under 6% level. And the reason is that because of the war, as we talked about it, oil prices shot up and oil production facilities were impacted. Shipping capacity has been impacted, and the oil shock has flowed through the broader market. And for market conditions to normalize, that is going to take some time to happen, because the infrastructure that has been damaged, they would take perhaps a few years to repair. Then also the Middle Eastern economies that were exporting oil, they had to stop production because they could no longer export their oil and they did not have enough storage capacity. So now to bring back that production up, that is going to take some time. And also with respect to oil, there is always a risk premium associated in the pricing of oil. And right now that risk is very high, especially related to the Strait of Hormuz. Anytime now the investors know anytime there is any unrest in the region, oil flow can really stop. So perhaps the price of oil can drop from the current $110 per barrel to maybe $80 or $90 per barrel. But I don't see it coming down back to that $65 a barrel level that we saw just before the war happened. So yes, mortgage rates can move in the right direction, but it's going to take some time for that to happen. And going below 6% will take quite a while to happen, in my opinion.
Okay. Well, I think there indirectly you just answered another question I was thinking about, and that was, are gasoline prices at the pump going to suddenly come down? And I think you addressed that as well, that they might be slow to come down as well, maybe even stabilizing at a slightly higher level. So now back to housing. If we look at affordability, affordability is really home prices and interest rates. So which one is really the most important right now?
I think both are important. In fact, a combination of both the rates, the price of homes, and in conjunction with the household income level. Because when a family is purchasing a home, they look at the monthly payment, and that payment, whether or not they can afford that, ultimately depends on their income levels. So if we compare some data from March of 2025 to March 2026, we see that incomes have gone up by 3.5%, whereas home prices have just increased by a little over 1% on average across the country. Mortgage rates are right now around 20 basis points lower than what they were last year. So all around, it's great for affordability. But then we have to remember that this is only just a slight improvement. It's perhaps a step in the right direction, but affordability has not just suddenly improved big time. And the reason is because home prices are very high right now. So for any large-scale change in affordability, either incomes would have to increase big time, or we have to see a large-scale drop in mortgage rates, which I do not think, as I just said, is happening anytime soon over the next few months. And I suspect home prices are not even going to crash at all. So we're just going to see those modest improvements in affordability, marginal changes in home purchases that are going to happen. So it's just like a small changes, small steps, and nothing major happening there.
All right. Well, you mentioned affordability, you mentioned incomes. That leads one to think about jobs in the labor market. So, how much does the labor market actually influencing the housing market right now?
So I think the job market matters a lot because even if the unemployment rate is low, a slowing job growth impacts behavior. As we saw in the most recent employment report, it showed that unemployment was at 4.3%, which is pretty low compared to historical levels. And that job report also showed that there was an increase of 178,000 jobs in March across the country. So on the face of it, that looks like a very strong employment report. But if you dig deeper, you can see some weaknesses. And that is because in the previous month, in February, the economy lost 133,000 jobs. So we're seeing a lot of volatility in the labor market. Also, 76,000 jobs that were gained in March, they were concentrated in the healthcare sector. But if you look at other sectors like financial activities, you look at the tech sector, both these sectors lost 15,000 jobs each. And if you look at the tech sector, there was a loss of around 56,000 jobs in 2026 alone. And then if you look at other numbers in the labor market, if you look at this other measure of unemployment that's also looks at discouraged workers and part-time workers who are working part-time because they cannot get full-time jobs, that number is up to 8% right now. And also the share of unemployed people who have not been able to find a work for 6 months or more, that number has increased to 1.8 million people. And that's 25% of the number of unemployed. Hiring rate right now is at the lowest. Outside of the pandemic, this rate was only in 2012. So we're saying that hiring growth has slowed a lot and people are not feeling very secure in their jobs. So even if somebody has a job and they're not feeling secure in it, they're not going to go and make that home purchase. So job security is important, income stability is important. And that's why what we're seeing in the labor market right now is holding back many people because of the uncertainty, because they do not know if they'll have that job at the end of this year after 2 years. So the labor market is weak if you dig deeper, but on the face of it, it looks like a very strong labor market.
Okay. So let's shift gears to housing supply. I think one of the things we have been saying for quite some time now is that housing supply is historically been very restricted. And that is what's driving a lot of what's going on in the housing market. So could you give us your insights on housing supply?
Sure. So housing supply has been improving. It went up to 1.2 million homes in February of this year compared to 1.23 million last year. And that this number for February 2026 is at the highest since the pandemic began. So inventory is rising up. It has been going up. But when you compare it to pre-pandemic levels, it's still lower. It's still restricted. However, there are many states where inventory actually is higher than what it was in 2019. And some of these states are, as you can guess, Texas, Florida, Arizona, Colorado, Idaho, Tennessee, Utah, and Washington. So there are some states where the homes available for sale have gone up. And so buyers have good choice available. Yet there are other states where it's still restricted. So inventory matters. Another thing that is playing in the market right now is that homes are sitting on the market for very long because it's taking longer for them to sell. I mean, demand is there, but demand is slow. So it's not that there is a surge of new listings on the market. It's just that there is stale inventory on the market. And also we are seeing that many homeowners who are putting up their homes on the market, if they are not getting the price that they want, they'd rather delist their homes than sell at a lower price. So yes, inventory has improved a little bit. It's improved. It's out there, but not compared to levels that we were seeing before the pandemic.
Interesting. Now, we've talked in the past about an effect known as the lock-in effect, speaking of the pandemic. And we know that back during the pandemic, mortgage interest rates plummeted to as low as 3%. And many people today hold mortgages between 3 and 4%. And we call these folks locked in to their current mortgages because if they decided to leave their current situation, their current home, their current mortgage, suddenly they would be faced with mortgage interest rates of 6 or 6.5%. So could you talk a little bit about what this lock-in effect is actually doing to the housing market today?
Yes. As you said, of all the homeowners, I think there are 30% out there who have an interest rate, a mortgage of less than 4%. And it becomes very obvious that they don't want to take up a higher rate of interest because financially it does not make any sense. Then there are other people who have a mortgage rate of 6% or higher. Now, if you remember that mortgage rates have exceeded 6% only since September of 2022. Before that, mortgage rates were at 6% or higher only before 2008. So all these folks we see with a rate of more than 6%, these are people who bought homes in the last 3 years. Now, if these people have bought recently, again, it makes no sense for them to move unless they have to move because buying a home means selling the existing home. That means realtor costs. Then if you buy a new home, then all the closing costs and moving costs. So again, there is no financial incentive. Then we come to those people who own their homes outright. So why aren't these people moving? A lot of these people have been living in their homes for a while. They have paid off their mortgages. Now, because they have been living in these homes for a while, they have developed emotional attachment to their homes. They have maintained, community ties. They don't want to give up all of that. And even if they are looking to downsize, they are looking to move into perhaps a home in the same neighborhood or nearby, and they're not able to find that home. Also, if they need to sell their home, again, that means they have to incur realtor costs, closing costs, moving costs. And if their home has appreciated a lot, then they would have to pay long-term capital gains on the home they sell. And perhaps they don't want to give up their current lifestyle and they want to age in place. So it's all these factors that are keeping people where they are. Of course, there are many people who are moving because of life events, and that will still continue to happen. But by and large, we are seeing that folks are not moving as much as before.
Well, you bring up an interesting point there. If we think back, especially to the early stages of the pandemic, there were a lot of folks who were migrating from one area to the other. For example, I can remember where Boise, Idaho suddenly became a net in-migration, where a lot of folks were moving from California to Boise, Idaho. In the past, we've had the snowbirds who've migrated from the Northeast down to Florida. And so migration was really a part of the housing market that we used to hear an awful lot about that maybe we don't hear as much about today. So how is population migration still driving the housing market?
So I think migration is evolving. Like you said, during the early years of the pandemic, there was a lot of movement outside from large metros to smaller places where people could find larger homes. A lot of people were moving from New York City, from California, They were moving to places where they could buy larger homes. People were moving to the Sun Belt in search of warmer weather. In fact, in 2022, more than 300,000 people migrated to Florida. Now that number has slowed down to just like around 60,000 people. So you're seeing a slowdown in that migration. And one of the biggest reasons is because of home prices went up and also home insurance costs surged. They've gone through the roof in Florida. So people are not moving so much. Of course, there is a net positive migration to Florida, but it is much less than what it was before. Those folks are rather moving to the Carolinas, perhaps, and to Georgia. And another pattern that we are observing right now is there is this small movement back towards the colder states. And the reason is because people are finding more affordable housing there. So we are seeing a movement to the colder belt. Also, another thing is we used to see snowbirds moving from these cold places to the Sun Belt. Now, because the Sun Belt has become so expensive, these people are not moving anymore. So we are seeing that dual migration pattern happening. One is not happening, and on the other hand, it is younger folks moving to these colder states. So yes, the migration pattern is evolving, but fewer people are moving, and then you can see from that because, like our forecast said, we are seeing the Northeast and the Midwest markets that are much hotter, whereas markets in Texas and Florida are much cooler right now. So because demand has slipped out.
Very interesting. So maybe a northward migration is occurring to some degree.
Yes.
So let's talk a little bit about what buyers are actually thinking right now. And as you've been going through some of your discussions, one of the things that came to my mind was, well, we have in the population today a fairly sizable number of folks who have enjoyed appreciation throughout the years and long-term ownership of their homes. So they essentially buy and sell without a mortgage, and they're all cash buyers. So do they even care about any of this? I think you also just mentioned the locked-in homeowners, and they're adapting perhaps, and they're satisfied and not planning on moving. So are we really looking, when we talk about buyers today, are we really talking about kind of those first-time home buyers where the interest rate is important, where a lot of these issues and economics are important?
I think you're right. When we're talking about, especially about affordability, it's mostly in reference to first-time home buyers, because folks who have owned a house for a while, they have seen a jump in their home equity, so they are able to afford that movement or to sell their home and buy another home. But even for them, if they have a low mortgage interest rate, they do not have any incentive to move. So it's because of cost. They don't think they can sell their current home and find a bigger one for something that they can afford. So really, yes, what you're talking about is mostly first-time home buyers for whom affordability matters, for whom mortgage rates matter and the price of home matters. And that's why we are seeing perhaps this slow migration to the north, to the Northeast and Midwest states, where homes are still affordable, where you can find metros or smaller towns where the median price of the home is lower than the national average. So yes, I mean, when we're talking about this whole discussion about rates and affordability, it largely centers on first-time home buyers.
Okay. Well, that certainly makes sense. Well, our podcast today is titled The 2026 Spring Housing Market, and we've been discussing many aspects, macroeconomically perhaps, that relate to the market, but specifically, what can you tell us about the 2026 spring housing market?
So before March, up until February, the general consensus was that the housing market had turned a corner. Folks were optimistic. This was going to be a good spring housing market with low mortgage rates, with an improvement in affordability. but because now rates have gone up, suddenly that affordability has been dented, but it's still there. That slight improvement in affordability is still present because rates are lower than last year. So we will see more sales this year, but just slightly more than last year. We will not see any wholesale improvement in the housing market. We are just going to take baby steps, as I said before. It's going to be a slight improvement or perhaps just the same as last year because there's also a lot of added uncertainty in the market, uncertainty with respect to the labor market, uncertainty with respect to inflation, uncertainty with respect to the entire economic situation. So folks who don't feel comfortable about making that huge purchase right now will step back from the housing market, and perhaps they'll wait and see where mortgage rates are headed. So I can only say that just same as before or slightly better than before.
Okay, that's fair. So the biggest, I think, question to address today, why do we care about any of this? Well, the reason we care about any of this is the time right to buy now? I know one of the things I always say is as long as your time horizon is long term and you plan to own a house 30 or 40 years, buying a house is like the stock market. You just start investing in the stock market, buy that stock, and over 30 or 40 years of ownership, you will come out way ahead, and the advantages of home ownership are there to be had. So, Rena, what would you say? Is this a good time to buy?
I agree with you that if for a specific family, they can afford that monthly mortgage payment, and if they feel comfortable, they are about their job security, I think it is a good time to buy because, as you said, this gives them that chance to build up home equity. But again, it depends on each individual person, how they are feeling about the market right now. If they are not comfortable, if they're not sure about their income stream, if they're not sure what lies ahead for them, then perhaps they should wait and watch because ultimately it is a huge financial responsibility that they will have to take up.
Well, Rena, thank you very much today for your guidance and insights. And thanks to all of you for joining us today on the House here on RiskWire. We'll see you next time.
Thank you.